Morning. I can see people joining, so we are just currently going to sit in a little bit of silence and give people a chance to join. So just bear with us a second. Morning, couple of minutes away from starting the webinar. People are still joining, so we'll probably start just after 10 a.m. this morning. So just bear with us while we let people join. Okay, the numbers are still going up, Amy. So we'll just give it another couple of minutes. It's 59 at the moment. I know what people are like. We click on it bang on 10 o'clock, so it takes 2 minutes to join. Okay, we're just on 10 o'clock, but I can still see a few people joining, so we'll just give them another minute, and then we will kick off. Still going up a little bit, so just give me 1 second. Okay, Amy, are you ready to come off mute? Yeah, good stuff. It's 10:01, almost 10:02. I think the numbers are still going up slightly, but we'll let people just join a little bit later on. So we've got an intro to do anyway first. So good morning, everybody, and thank you for joining today's webinar, which is a money laundering update, which is presented by Amy Bell. I'll just start. My name is actually Adam Bullion from Practice Evolve, and if you just click on the slide for me, and just so as you know who we are, because there will be a few people joining today who don't necessarily know who we are. We're Practice Evolve, and we provide business operating software to over 550 law firms. That currently means that we're servicing over 10,000 users across Ireland, UK, and Australia. But today we're not here to talk about Practice Evolve necessarily. We're here more to talk about AML, and I'm delighted that Amy Bell's joined us today as part of a series of webinars that we've got coming up over the next few months. These webinars are very much designed to shine a light on important topics, including regulation, including fraud, cybercrime, and also issues that firms are starting to consider as they look to the future, including pricing and value in a world that really is changing quite rapidly. So today, if you click on Amy, today Amy's going to be talking about AML and the possible future shape of the supervisory regime, regulations that might change and what you can do about it. But I'll let Amy go through that and introduce it herself. Just a very small bit of housekeeping here today. I just want to make sure, I'm sure we're all really used to using Zoom nowadays, so it shouldn't be too much of an issue. But if you have questions as we go through this, obviously you can hear us and you can see us, but we can't see or hear you. So you've got a Q&A button down the bottom. If you click on that, that should bring you up a panel where you will be able to ask questions as we go through this. So type those questions in, and I will try and keep up with the questions and ask Amy as we go through the presentation. That's not always possible depending on how many are coming in. So as they do come in, I may leave some until the very end and then come back to Amy at the end with questions and answers. Amy, I'll let you. I'll hand over to you. I'll go on mute and I'll speak to you towards the end. Thank you.
Thank you, Adam. Hello, everybody. If you've not met me before, I'm Amy Bell. I'm a solicitor and founder of this business, Teal Compliance, and we help law firms with all the rules and the regulations that they need to follow. I'm also a volunteer at the Law Society. I've volunteered there for probably about 12 years now. I'm the current chair of the Economic Crime Task Force. Regular viewers of mine will have noticed that used to be the Money Laundering Task Force. And actually, for reasons that I will come on to today, and in one of the other sessions that we're doing for Practice Evolve, we're talking about why we've made that change, actually, because economic crime is a much wider topic than AML, and we need to reflect, need to make sure we keep up with the regulatory objectives, which I'll talk about as we're going along. This session's designed for mainly money laundering reporting officers. It's the technical stuff that you need to know that is changing. And what you'll need to prepare for in the coming months, possibly. Who knows? I mean, we've just had a change of government, so that's all exciting. We'll have to find out what's going to go on. And we're waiting for the King's speech today, aren't we, to see what laws he's going to bring in. Hopefully, he's not going to bring in a failure to prevent money laundering for reasons I'll come on to later on. But one of the major pieces of legislation that came in this space was at the end of last year. We got the Economic Crime and Corporate Transparency Act. And there's a few parts to that we'll talk about. The second session I'm doing for Practice Evolve, particularly, we're talking about it's not just AML anymore. And we can see when you look at the Economic Crime and Corporate Transparency Act, which is big, that they're actually trying to tackle lots of things, fraud being one of them in particular. But one of the things that we've reflected on, or the government have reflected on, as a result of quite a lot of lobbying, actually, is the state of Companies House. We know that from the money laundering regulations, we're unable to rely on the PSC register solely when we're trying to identify beneficial owners of companies, which is nuts, really, because the whole point of that register is to say who they are, but we're not allowed to rely on it. And the reason we're not allowed to rely on it is because concerns over the accuracy of the information going into Companies House. We've seen this in other bits of reform more recently. So we had, after the Russian invasion of Ukraine, we had the register for overseas entities, about trying to get transparency over who was owning properties in the UK. And because the whole point of this, like, it started quite a while ago, recognizing that the criminals will hide behind corporate. They'll create corporate that will give them an air of kind of legitimacy. They'll involve lawyers in creating those entities. And they do that just to hide their identity so they can get up to whatever they want to get up to. If you, I don't know if you do follow, but I would recommend, if you don't already follow a guy called Graham Barrow. If you're on Twitter, he's very active on Twitter. He's not quite as active on LinkedIn. He's one of the co-presenters of the Dark Money Files podcast, which, if AML is your thing, I also highly recommend. And he's been campaigning for a really long time about the weaknesses in Companies House, in that, you know, it's really easy to create a company. There are no checks. And that means that we can't rely on the data that is in there, which, as I've already said, is a bit nuts, because it's supposed to be something that we use to identify our clients. So the government have finally recognised this. And I mean, they've been talking about it for about 6 or 7 years, but they finally recognise it. And so they're starting in this Economic Crime and Corporate Transparency Act to start to reform Companies House. So there's a few things that are already came in March. So you've got to have a company that is for a lawful purpose and not an unlawful purpose. As it said, if you follow Graham, you will see that people create companies for all kinds of things. And what they're also doing is hijacking other people's addresses or using service addresses. And so it's a requirement now to have an appropriate postal address. You can't use a PO box anymore. You've got to have an appropriate postal address. Where and why, by appropriate, they mean where it's reasonable that documentation sent by Companies House would be received by the company if they sent it there. So I don't think there's a problem using service addresses, as long as somebody is going to receive them. Similarly with email addresses, they have to be appropriate in that, you know, it'll actually reach the right person. There was also some changes in May around fining powers, really, and charging. Not a massive impact on us. What will have an impact on us is the changes that are coming. Now, I'm going to say are coming. I'm not going to say when they're coming, because one of the things that happens when you have a change of government is that the new government go and look at absolutely everything that's happening and decide whether they still want to do it or where they want to prioritise it. But this is the intention in the Act, and given that the Act's passed, I assume they are going to go forward with it. I'll kind of give a bit of a slight aside in a minute about what I think the impact of the new government might be on AML generally. And what they're wanting to have, and we see this similar situation when it comes to register of overseas entities, is authorised corporate service providers that to act as gatekeepers. So basically being given a status that you're authorised, Companies House know who you are, and that means that you're going to be able to, well, you're going to have to follow some processes in terms of assuring the legitimacy of any companies that are created. It's in the same way that we have verifiers. If you're familiar with that, we had to have verifiers of the information that was going in relation to the register of overseas entities, very similar. Additional registrar powers, particularly around demanding information, querying the purpose, rejecting companies, especially if they're challenged. So you can see this is all about repairing what's on the register, making sure we can start to get confident about it. And one of the main things that will come for people who are interacting on Companies House, so existing companies and new companies, will need to be a verification of identity that they actually exist. I mean, it's mind-blowing, isn't it, that they don't actually check that now? But I think they will probably implement something which is a kind of, you know, like we see now in AML CDD with a kind of biometrics. The government are also consulting and working really hard on bringing in digital ID, so there's a single source of truth for somebody, that you register, you know, you prove who you are, and then you've got a digital ID number that people can use. That will not work for everybody, but maybe combined with this efforts at Companies House to mean it, that the Companies House and us who are looking at the information have got some comfort that the directors and the persons with significant control actually exist, which would be nice, wouldn't it? And also verification in relation to the shareholder information, and an address where you might be able to find them. So remember, if you've seen me talk before about AML, you will have seen me talk about what is the purpose of all these companies' house inquiries we have to do, or even passports and utilities in relation to individuals. That's all about knowing which door to knock on to find somebody. And so this is about saying, well, this register says which door to knock on to find these people. Let's make sure what's on the register is actually accurate. So that's some reform that's coming from the Economic Crime and Corporate Transparency Act. There's other things that are coming from it, which I'll come on to later on in relation to regulatory objective. And as Adam said, talking about how that affects supervision in the space. We've also had relatively recently an updated SRA risk assessments. They had one last July and they had one now in March. So a practical thing to do, money laundering compliance officers, you need to make sure that next time you review your practice-wide risk assessment, that you have reflected on the most recent information published by your regulator, if you're regulated by the SRA. I mean, it's interesting that they brought out one, quite quickly after the last one. There's some new things that they've highlighted. I mean, we know that the Solicitors Regulation Authority risk assessment does reflect the national risk assessment, but they then bring in things that they are seeing that maybe isn't that visible in the national risk assessment, that they're seeing through their supervision activities, things that they're concerned about. What we are expecting actually probably early next year is an updated national risk assessment. So if you're recalled to training you might have had about these risk assessments, you've got your national risk assessment, and you've got your sectoral risk assessment, then you have to do your practice-wide risk assessment, and that needs to translate into your lawyer's client matter risk assessments. It's a cascade of risk assessments. So this is an update to kind of prong 2 of the risk assessments. We're actually expecting an update to the overarching national risk assessment. They have started consulting on it. With my Law Society hat on, part of the task force have already met with the government to discuss the risks that we see. And yeah, so look out for that one. That should be coming. I think with the change of government, that's led to a delay. And also, what happens in between these national risk assessments, the last one we had was in 2020. What happens is the whole team that were there before are not there now. So they're having to do a degree of learning before they can make the observation. So I think it's going to be maybe a kind of 9-month process from now. But certainly, if you follow me on LinkedIn, I'll definitely be talking about it a lot when it comes out. So anyway, back to the SRA one, which we've already got. So vendor fraud, they have flagged up as an issue that we should be aware of. Now, if you are a firm that does conveyancing, you'll already know about vendor fraud. You will have heard about green bar and all of those things. So, it's made its way finally onto the sectoral risk assessment. Of course, vendor fraud isn't in itself money laundering. It's only money laundering after the fraud has taken place and you've got criminal property. But they are flagging up the risks that we should be thinking about. And so these should be incorporated into any training that you're doing or any documentation you've got that letting your lawyers know about risk, particularly, as I say, in relation to residential conveyancing. And the hallmarks that we see of this, I'm sure you are already familiar with, but just in case, properties being offered for sale over or under the market value. If it's over the market value, that could be a money laundering scam. If it's under the market value, it's because they've been trying to attract a buyer really quickly so they can pull the fraud off. Reluctant on the client's part to provide documentation. Well, that's because the client's not really the vendor, and so they haven't got the documentation to give you. That said, folks, I mean, it's really easy to get fake documents. It's really easy. I mean, don't do it now, but you could go onto the internet and put in fake utility bills, and you'll get taken to, you'll get presented with a list of options on Google of different vendors of template joke utility bills, 30 quid maybe plus VAT you pay for access to these. And essentially they are genuine looking utility bills. They just have specimen across the thing. If you know how to take a watermark off, then you're laughing. The baddies know how to do this. It's you know, it's interesting that what they want is something that only the real person should have, that they would only have at that address. But it's not hard to forge them if I'm honest. It's a bit harder to forge things like passports, identity documents. And that's why often in our client due diligence electronic verification systems, we will try and validate that that document is genuine. One of the things that we are seeing emerging is concern amongst the community, as in the client due diligence provider community, of how the baddies are manipulating that. So, you know, we've got now in electronic verification, we've not just got looking up some databases like credit files and using an MRZ code algorithmic check on the document and liveness checking. The baddies have already figured out how to get around all of those things. They've used AI to be able to crack the algorithm for the MRZ code, so they know how to get the right MRZ codes now. They are using deepfakes and AI generated images to be able to fool liveness checks. So it is a hot topic, actually. I understand that earlier this year there was a meeting in Westminster of the government at the time, and vendors to say what we're going to do about this, because it is a real issue for us. You know, we're using what is the reasonable approach to it, where we hope that there are measures in there to prevent fraud, but it's not going to be infallible. Other red flags for vendor fraud is the pressure to complete the transaction very quickly. This is because they have got to get in and out. Like, you know, you've got to think about these vendor frauds being an alternative to doing an armed robbery. I mean, apart from the violence bit, but you know, when you're planning a robbery, you're going to get in and out before they press the button, right? It's the same with vendor fraud. You've got to get in and out before someone detects things are going a bit strange, you know, that the post is going missing, that you know, you might be getting phone calls about things that don't make any sense. Your emails might be interrupted if that someone's trying to do an impersonation fraud attached to someone who's selling. So there's pressure to get this done really, really quickly. And they may skip things. Now they've got here instructions for minimal work to be done. For example, no searches requested. I don't think that's a vendor fraud one particularly. I think it's much more likely to be a money laundering, a red flag you would see in a money laundering activity. So, you know, money laundering is about putting the dirty money into the banking system, layering it, and then giving it to the criminals. And so when you're layering, what you're doing is you're just doing transactions for the sake of it. That's why we ask people to look out for, is there an economic or legal purpose for this transaction? Because if there isn't one, particularly accompanied by an overvalue, you might think this is just about layering. And of course, a baddie that is selling his house to a mate just for the purposes of layering, the mate's not going to need any searches because they're not pulling out the transaction. They're just going to buy it because the whole point of it is layering. So, you know, if someone's not interested in the normal processes that you would advise to protect somebody, you've got to wonder whether that is a red flag. Complex or unusual circumstances around the transaction. Again, that's one of the things that we ask you to look for in matter risk assessment. We know that while I'm talking about matter risk assessment, we know that the regulator last year talked about their concerns about matter risk assessments. They issued that warning notice about matter risk assessments. One of the key things I look for when I'm looking at matter risk assessments is, are we asking these questions? Is there an economic or legal purpose? Is there complex, unusually large, unusually complicated aspects to this transaction, funding or things like this that just don't make sense for this kind of client? Cash property purchases, you know, and I don't mean foldy plastic cash. Have you had one of those notes yet with a king on? I got one the other day. Hardly ever have cash. Like, people hardly ever have cash these days, right? So, but what we're talking about here is that somebody's got a load of money. Now, there's loads of legitimate reasons for this, of course there is, but if you're a money launderer trying to layer your things on top of your previous layering activity, you are going to have a load of cash for a cash purchase. And third-party funders. Now, third-party funders is you know, not necessarily a vendor fraud thing, because if you don't have third-party funders when you're selling, you only have them when you're buying. But I think this is a real key red flag for people to be thinking about with third parties. We do know that the Legal Tech Affinity Group are really concerned about this. If you don't know who the legal sector affinity group is, it's made up of representatives from all parts of the legal sector, from the solicitors part, from different geographical areas like Northern Ireland and Scotland, as well as England and Wales. We've got the licensed conveyancers in there. We've got SILEX, we've got the bar, we've got the notaries. And basically representatives from each of those organisations attend the legal sector affinity group, and the legal sector affinity group currently come up with the drafting for the guidance that we all have. And there is some guidance that came out last year, which is currently in draft form. And part of the reason it's in draft form is not all of the LSAG were unanimous on agreeing the wording in that draft, and so Treasury haven't approved it yet. Part of that is some wording that's gone in there about proving source of funds in relation to third parties, suggesting that you should, it's not a must, but you should be seeking documentary evidence of what you're told in relation to a third party. Now, for some situations that would make sense. We do, ordinarily in conveyancing, I reckon, do look for source of funds, source of wealth from a third party as if we would do our client. But there are other transactions where you might not think it's appropriate to go and do source of funds, source of wealth on a third party funder. For example, a company in a group and another company is funding, making a intergroup loan to be able to fund something. And it's a very well-known company, you're going to get bank statements from them. So the problem with a should in guidance is that basically that's what the regulators will expect you to do unless you can explain why it's okay not to do it. And clearly repeating this in the SRA sectoral risk assessment is something that they really want you to be thinking about in terms of a risk, certainly a risk, and what you should do to respond to it. I do see these days quite a lot of firms do have a policy about the funds coming from third parties. They might differentiate in those policies between funds coming from someone for the purchase of a transaction, or funding a transaction, and then funds coming to pay a bill. They might make a distinction between those two in the policies. But yeah, certainly, whilst there's no requirement in the regulations to flag that up, what you do in relation to funds coming from third parties, I think practically you probably do want to have a section in your policy if you haven't already about that. Being instructed to act for both the seller and the purchaser in the transaction, again, potentially probably not a straightforward impersonation vendor fraud, but certainly a hallmark of money laundering. Whenever I see the parties are connected, that obviously gives an opportunity, if those parties are baddies, to layer. The baddies keep people close, right? They don't generally involve the general public in their laundering if they're adding layers. So yeah, looking for the connection between the parties and whether it makes sense. And back-to-back flipping, I mean, we used to see flipping a lot. We don't see it quite so much anymore, but of course flipping could add layers really quickly, and a baddie would like to do it because it would confuse everybody as to who's where. One of the other things that they flagged up in the latest sectoral risk assessment is supply chain risk. And so a supply chain refers to the end-to-end activities involved in the provision of a service to the end user or customer. Now, this won't be relevant for everybody. Of course, most people in smaller law firms, and of course, they make up the majority of the law firms in the profession. You're doing a transaction and it makes sense. This risk really is about the larger firms and this kind of typology that people are concerned about, in that larger clients may have a number of law firms acting for them in different bits of something. I recently had a few networking events with larger law firms, and that was reflected in their experience. They might be doing one tiny weeny bit of a deal because they've got a specialism in something, or an experience, or they've got an office that covers a particular jurisdiction that's needed for part of that deal. They're not seeing the whole thing. And this comes down to understanding the purpose and nature of what you're being asked to do, and whether that makes sense that you'd only be asked to be doing this little thing. If it doesn't make sense to you, you might want to consider whether that's to keep all of the parties' prying eyes away from the whole deal. So that's what they're really talking about here. Purpose and nature we often equate to source of funds, source of wealth, but it isn't it isn't just that. It's like, why are they doing it? These questions, again, is it complex? Is it unusual? Does it lack a legal or economic purpose? Those are questions that you need to ask when you're considering purpose and nature of the transaction. So that's the sectoral risk assessment. One other bit of law that changed recently in January 2024, 10th of January. They keep bringing legislation in on the 10th of January. No, they did that in 2022. Don't know why. But anyway, I think that might be the first day everybody's back, like in government, to get someone to stamp something. Who knows? But from the 10th of January 2024, the way in which domestic PEPs should be treated has changed. This is taken from the SRA document. Okay, domestic PEPs are now defined as those PEPs entrusted with a prominent public position by the UK and are subject to a different level of risk assessment and enhanced due diligence. They go on to say that the difference is as follows. The starting point for the assessment is that the customer or potential customer presents a lower risk than a non-domestic PEP. Okay, so let me just give you some background to what is going on here. So a politically exposed person, I'm sure you're familiar with them. Your electronic verification, if you use one, checks for them. Basically, they are a person that has been entrusted with a prominent function, public function usually, but not exclusively, in a country's infrastructure. So high up, a minister with some control with a budget, high up judges, managers, people in charge, CEOs of state-owned enterprises, things like this. And then you've got your secondary PEPs. So your secondary PEPs are people that might be related to them. So close family members, parents, children, siblings, spouses. And you've got this business of someone who's in a close business relationship. So basically shares a beneficial ownership with a PEP, makes their business partner become a PEP, essentially. So PEPs were first introduced into the regime back in 2007. And they were introduced because of a fear of terrorist financing. That these people that have got these roles might have access to public funds that they could divert for the purposes of terrorism. In 2017, it was originally just foreign PEPs. In 2017, they expanded the definition of PEPs to include domestic PEPs. And of course, we have, as every country does, a load of domestic PEPs. And what happened was, when this legislation, the 2017 money laundering regulations, was going through, some countries started to, because it was an EU bit of legislation, some people started to kind of implement earlier than we did. And some of those people were banks which might be headquartered outside of the UK in Europe. And so they implemented this domestic PEP checking earlier. And so people who previously not been subject to enhanced due diligence by virtue of being a PEP suddenly were, and they weren't too happy about it. And so in the House of Lords, there was an amendment made to the Bank of England Act in 2017, requiring the Financial Conduct Authority to issue guidance to say domestic PEPs are not as high risk as the foreign PEPs. Now, they did issue that guidance. But it seems to me that it wasn't really adopted, so that domestic PEPs still were feeling the pain of having to go through enhanced due diligence. So what do we mean by this enhanced due diligence? We mean definitely making sure that they are who they say they are, but more proving that any funds that they're using is legitimately theirs and not anything they've siphoned out through their position. The other thing that happened in 2017 is they expanded the definition to include governing bodies of political parties and also people on international committees. And so the focus from 2007, which was more about terrorism, kind of expanded by 17 to be about terrorism and bribery and corruption, people who might be corrupted, people who might be influenced. So obviously this guidance didn't work. And also that guidance, there was no similar guidance issued to the lawyers because we didn't have any legislation telling us to do that. So the LSAG guidance didn't make this point. So they took the opportunity to change it in the law to give people assurance and comfort that if they want to treat domestic PEPs to a lower standard of risk, then they're okay to do so. And that's what this bit of law is. Okay. Now, I just want to be just be really clear about this, because I do think that the drafting in this practice-wide risk this sectoral risk assessment isn't particularly helpful when it comes to domestic pets, because I think there's a risk people could get confused. Okay, so what they're saying is the difference is that starting point is that their risk is lower than a non-domestic pet, and if there's no enhanced risk factors present, the extent of EDD measures to be applied is less than you would apply for a foreign pet, a non-domestic pet. So what this is saying is, really, the way to look at it is, if you've got a domestic pet and the only risk factor that would make it high risk is this pet kind of qualification, the fact they qualify as a pet, then there's no need to necessarily treat them to enhanced due diligence just because they're a domestic pet. That's what they're getting at. I don't think it's particularly clear, but that's what they mean. They mean if you've got this client, so you've got a client happens to be a brand new minister somewhere, and they come along and they're instructing you. They're a domestic pet. They've just been got a new job in Westminster, and they've become a pet. If that's the only factor that would mean that looking at them as a client or their matter, you'd have them as high risk, it was only that they trigger the pet thing, then you might kind of discount the pet issue and treat them to a lower level of due diligence. So you wouldn't necessarily go to the same extent of due diligence that you would with a foreign pet. Be really careful about that, because in Regulation 33, there's a whole list of things that would trigger enhanced due diligence apart from pet. And so in order to kind of properly apply this domestic pet business, you'd have to be sure that none of those other factors are present. And currently, when we're doing our risk assessments, we're probably not making sure our lawyers go through every single one of those sections to eliminate them all. So what does this mean in practice? Are we going to actually use it? Are we going to be in trouble if we don't use it? That's got to be what the question on your lips at the minute. Okay. It is for your firm to decide its risk exposure, okay? And it's for your firm to decide. This, the wording I felt when I read it from the SRA seems to be telling you must treat these PEPs as lower risk, but basically taking away your right to have a one-size-fits-all pet policy. What this potentially suggests is that you've got a pet policy for domestic pets and then a different policy for foreign pets. What I know from speaking to the banks after the 2017 guidance came out is that they were nervous about running two different PEP programs, one for domestic pets and one for foreign pets. You see, the thing with compliance is you've got to balance what the law wants you to do and how you can actually practically get it done. So the more degrees of separation and variation you introduce, the more risk is that people get things wrong. So in the banks, as I say, I don't think we saw much change, which is how this law turned up because they weren't following the guidance that they had. For you, I think you need to, next time you do your practice-wide risk assessment, I think you need to address this point. I think you need to have a think about it. It'd be useful if you reflect on your register of PEPs. Hopefully you've got one. So you know what you've got, how many domestic and foreign PEPs have you got? And then maybe review them backwards and say, well, in the case of our domestic PEPs that we've done enhanced due diligence on, if we look at the risk factors for those clients, would we have been able to skip a load of that enhanced due diligence because that was the only risk factor? I think by doing that exercise, you're going to be able to think about what the practical way forward is for you. I do think it's going to be a decision about, are we going to have two PEP processes or one, essentially. And as I say, if you're going to go with two PEP processes, the critical thing will be to make sure in the case of domestic PEPs that you check carefully whether there are any other risk factors present in Regulation 33. Okay. So yeah, that's about domestic PEPs. Now, there was an interesting comment in there about pooled client account. Pooled client account, super topical for a number of reasons. Number one, the regulator has just closed, I think, I think it just closed last week, a discussion, not a consultation, a discussion about client protections And one of the things tucked away in there is is it appropriate for law firms to still have a client account? That's a big clue. And we also have Paul Phillip from the SRA publicly coming out and saying the cost of compliance would with money laundering regulations would drop like a stone if firms didn't have a client account. It is absolutely categorically not true. I'm sorry to say, it's not true. The cost of compliance for a law firm comes because of the work that you're doing, not the way that you transact that work. That would be to say that any firm that doesn't have a client account doesn't have AML risks. And all the American firms, or most American firms, do not carry a client account, and yet they are still within scope of the regulations when they do work in London. It's not true. Client due diligence and all of the work you've got to do, all the policies and procedures you have to do, come as a result of the work that you do, not how you do it. So there is no possibility of the cost of compliance for AML purposes dropping just because you don't have a client account. Because, you know, the alternative might be to use a third-party managed account, which I'll talk about just in a little minute, and that you'll still have to comply with the regulations. You'll still have to think about source of funds, source of wealth. So I'm afraid that's misconceived, that the costs would drop like a stone. It's not the case. And actually, I think it will add more cost. But let me just pause on this point before I go on a bit more about that consultation. One of the things that I see quite often, and this is, you know, in line with advice I give to my clients fairly regularly, which is when you are engaging with a client, you are often wanting to ask for money on account. And a lot of firms have put into their engagement letter their client account information. Now, the problem is sometimes with clients, you can't client due diligence before you send the client account, before you send the engagement letter, and therefore send them the client account information. Once they've got the client account information, they can put money in your bank and you can't stop them. And so one of the problems with that is you can create a money laundering risk with this. There is a disciplinary case against a firm, Taylor Vinters, which is now part of Mishkondaraya. And Taylor Vinters, part of the things that they were criticised for, it's a substantial fine, maybe £17,000, something like that. One of the things they were criticised for is that they'd received into their client account monies on account before they'd completed the client due diligence. Now, in the actual circumstances, this was happened because somebody else had supplied their client account information to a potential client, and the potential client was trying to buy a property off plan and was told, just pay this money in and you'll be fine. You know, you'll secure the flat or whatever it was he was trying to buy. But the firm, just this money just turned up. Like, this happens all the time to law firms, right? You all have those emails that go around, is this your money? Is this your money? Whose money is this money? Please tell me. It's been in the account for 5 days and I don't know whose it is. Those emails, right? Well, you know, that happens. And one of the things they were criticised for was accepting the monies before they'd done the identification and verification of the client. So this is why I'm saying, depending on how your process works, you might want to wait to supply the client account information until after you've identified and verified the identity of the client. You know which door to knock on, you know who they actually are. Now, I say that, and some of you, if you're not just responsible for AML and you're responsible for other things like professional negligence risk and cyber, you might have had contrary advice for that by your insurance company or broker or someone in the insurance space. Because what they're saying is, we're worried about this interception fraud where somebody comes along, a baddie infiltrates somewhere, our system or the client system, and then gives them different bank details to send monies to. It's a different thing altogether, right? That's a fraud risk. And so what we had when that became a thing is the insurance industry saying, well, give the clients the client account information at the very beginning and say, we're not going to change them. It's always going to be those. So if anyone tells you we've changed them, it's probably not true. And so we've got this conflict between what a practice you might have adopted for preventing risk of infiltration fraud and what the regulator is saying to you is creating a risk of money laundering. And you've got a tension between these things, and this happens quite often. To people who are new to compliance, I explain that you end up, or people not from the legal sector, you end up quite often with these competing priorities that you're trying to risk manage. For me, I think I would probably, and I would say this, wouldn't I? But, breach of the money laundering regulations, facilitating money laundering are criminal offences. And so I appreciate where the insurers are coming from, but I do think that we need to make sure that we're not facilitating money laundering. Okay, so there we go. Third-party managed accounts. Now I mentioned, what's the alternative to client accounts, and will third-party managed accounts be the answer? I just really don't think they will. I don't think they eliminate the risks of money laundering, because money laundering happens through the client account a couple of ways. Firstly, it happens because there is a money laundering 101. Someone pays some money in and asks for it back. That's money laundering 101. Okay, but most money laundering happening through the client account is actually just transactional. It's adding layers by moving the asset, by changing ownership of the asset to add layers of it. And so those transactions will still happen, even if there's a third-party managed account moving the money, they'll still happen. So I don't think that they eliminate the risk. And actually, I think what they do is increase the cost. Now, they have said in the sectoral risk assessment to think about, if you're using them, proper due diligence on providers. So, you've kind of got the AML bit of the SRA saying, oh, be careful about these third-party managed accounts. And then you've got another bit of the SRA going, well, client, it's no longer appropriate for lawyers. It may no longer be appropriate for lawyers to have a client account. So let them use third-party managed accounts instead. So that's a little bit of a contradiction. So anyway, I don't know if the link, actually, I haven't checked it today, it was still available, but they didn't run a consultation with a kind of program. But they'd had this kind of, we're going to have a discussion with the profession. So if you've got any views on this, I'm sure you could still get in touch with them and say, actually, I think we have to have a client account because X, Y, and Z. I mean, my firm view is, I think it's for the business to think about its risks and its opportunities, and how they're going to manage their client account, rather than to be dictated to by the regulator about whether you're allowed to have one or not. There is fraud. And as I say, when we do the next session for Practice Evolve, talking about, it's not just AML, it's also fraud, we'll definitely talk about, the fraud attached to fraud risk attached to a client account. But yes, I think that the risk here is, by removing the client account, it would be a real culture change in the UK, because everybody knows that they pass the money to the solicitor on trust and then they move it, and that's how transactions work here. The alternatives are escrow or third-party managed accounts, and they will add a cost per transaction. So you start to think about conveyancing, which is already quite price sensitive. Adding the cost just doesn't make much sense to me personally. Maybe it does to you, to pass the risk on, but you would still retain quite a lot of the risk. So source of funds, source of wealth. Okay, things that you're supposed to be spotting. Before I talk about this, I mean, one of the interesting things from practice is that we don't always see what is intended by the law being followed in practice when it comes to source of funds, source of wealth. We see a lot of confusion about what is the difference between source of funds, source of wealth. And we'll see in a little minute, the government have just consulted on whether there should be more guidance in relation to source of funds, source of wealth. One of the things that I think that the regulators identified is a lack of attention to the documents or the evidence that you are getting for source of funds, source of wealth. You're not paying attention to it. So one of the things that they're flagging up is that if you are getting bank statements and you see irregular payment transfers, you need to ask yourself why that might be and understand the typologies. So what we see when criminals are trying to evade bank monitoring for the purposes of money laundering, so you're looking at bank statements, so if they're a baddie, they're concerned about the bank's monitoring of them. You would see irregular payment transfers. You'll see sums of money moving below a certain threshold, possibly 10,000 or 50,000, depending on the type of bank account. There are some types of bank accounts where the threshold is 1 million, so you would see transfers of just under 1 million, just so they don't hit the transaction monitoring in the bank. And what they're basically saying here is, if it's on your file, you've got a bank statement. I know it's the bank's job to think about their transaction monitoring, but it's also your job to see if there's any red flags in there. And then what they're worried about is just people collecting, looking at the dates, have I got 3 months bank statements, and filing them on the file and not actually reading them. I think this will become a more prominent issue as the regulator moves on through their journey of examining all the constituent parts of an AML program. What I mean by that is you'll remember that they started with practice-wide risk assessments. We're all the way up to training at the moment, their latest thematic. It seems to me at some point they're going to want to have a deep dive into source of funds, source of wealth, and come out with some views about what they expect. And they're starting to do this in this sectoral risk assessment, start talking about these things. My advice is follow the money. Like, why are these transactions happening? Where are they going? Are they going into different accounts? If money's bouncing about, that definitely is a red flag that might start to make you think about money laundering. Adam, I'm conscious of time. I will leave time for some questions because I can see that some are coming through. So just explain this consultation. This consultation is just closed in relation to the money laundering regulations. It was launched obviously by the last government, and it was launched in line with a wider piece of legislative reform based on Brexit. Basically, any legislation which came down to us as a result of being members of the EU is being examined to say, is this still fit for purpose for the UK today, or should we depart from what we were told to do by the EU, basically. And so they've had it isn't a case of having a consultation and completely having new regulations. This is about amending existing regulation to make sure it works. So there were questions in there about triggers for client due diligence, whether we should have more source of funds, source of wealth guidance, whether that should be mandated. How do we facilitate digital ID? Whether we remove some of the enhanced due diligence risk factors that I was talking about in Regulation 33 around the types of industries and things that people might be involved in, some types of products people might have. Whether the enhanced due diligence you're required to do for a client established in a high-risk third country makes sense, or whether that's just overkill and not really an issue for us. Whether we should reintroduce simplified due diligence for the pooled client account. It was used to be automatic. It was then in 2017 had to be subject to a low risk assessment by the bank in providing you the pooled client account, and should we kind of make that a bit easier? So, and that consultation is closed. We probably would have probably a 10-12 week delay in when we would be expecting to hear about that. So we were hoping to hear kind of by the end of the year about the outcome of this with amending regulations. As I say, we've had a change of government. I did say I would kind of pause and say what I think about that. It is clear that when we look at the history of legislation going through Parliament when Labour have been in opposition, that they have pushed for stricter in relation to AML, tax evasion, things like this. So things are not going to get any easier, folks. I'm sure you didn't expect them to when it came to AML, but we may see that there was I did kind of say failure to prevent money laundering. That was a Labour amendment in the House of Lords to the Economic Crime and Corporate Transparency Act. Now it was removed and resisted in the end, but it'll be interesting to see what activity. I think that security, the new Prime Minister has already said, is a priority for him and his government. So we will have to see how AML falls into that. It's not going to get any easier, folks. That's it from me.
Thank you, Amy. Just before we go on to what's coming up, there are a couple of questions for you. So, which I didn't ask you as you were going through your flow, because I think you were full flow.
You're going to be able to get a word in.
Yeah, exactly right. So the first one there is gifted deposits. If a donor, i.e. parents, have been ID'd and provided bank statements, are they able to send the funds direct to the law firm in that case?
Well,
I suppose
it's a bit artificial to say. This is a really interesting question because it's come up recently about, is this a banking facilities issue? So there's two separate issues. There's the money laundering one, which is, have you checked out the source fund, source of wealth? Okay, you have checked out the source fund, source of wealth, so you've dealt with that third-party funder point. You're satisfied that this money is legitimate and it's coming from them. There is no reason that they have to pay it to their child to pay to you in money laundering. There's absolutely no reason for that. there should be no reason that that's a banking facilities breach either, because that money has to be paid to the law firm in connection with the instruction. And so it seems to me to be an artificial step to make them pass it to the child before they pass it into the law firm. The risk, obviously, is if the thing falls down and you've got to send the money back to them, and then you're like, oh, hang on, is this money laundering now? You know, is it fallen down? So, you know, I've never in practice been concerned about mum and dad having our bank details and paying the money straight to us, as long as I know it's coming from them and I'm satisfied it's clean. I've never really had an issue with it.
Okay. Thank you. The second question: if bank account details are shown on the firm invoice for payment purposes, is it safer to show the client accounts or office account details, bearing in mind the risk of other random funds being sent to that account in an attempt to launder it?
It's another good question. So depends where you want the money coming into. What I often find with law firms, even though you can get fees paid straight to office, what I find is that I find many more firms worried about clients accidentally then paying subsequent money into the office account and then them having a breach. So if they pay client money into the office account, there's a breach. So say they overpaid your bill by accident, and that then the surplus becomes client money, it's in the wrong account and you've got a breach. So quite often, even though the rules have been changed to enable you to pay money straight into office in payment of a bill, I still see firms opting to have the client account one. I see that as well with card machines. You know, when you are attacked, this dilemma often comes up when you are getting a card machine, and like, which account should we point the card machine to? And for the same reasons, even though you're just taking fees normally through the card machine, or you might have two card machines. I've come across firms who just refuse to have a card machine for the office, and they only want it for client, just so that money goes into there and it can be controlled compliantly, and then we can move it over when we need to.
Okay. Thank you. And then what's the one thing that everyone should do after this session, Amy?
Oh, yes. So for most law firms, if you've not already been inspected, the regulator hasn't come out and said this. I'm not going to kind of over egg the pudding. But they are getting round a lot of law firms. Last year, they saw 178. And the firms, from the clients that ring me and get in contact with me, they've kind of, I would say they are currently on the firms that they're selecting, and they don't share with me how they select them, by the way, so I'm not giving you any intelligence that they wouldn't want me to give you. This is my guess. It's my educated guess from what I see out in the sector. They are starting to come and visit firms that I know haven't had anything that's pinged from a regulatory point of view. You know, they're not firms that are complained about very often, but they are firms that are doing full service stuff, high street firms particularly, or local kind of regional with a number of offices type firms. They're the ones that are getting the phone call at the moment saying, or the email saying, you've been selected for an inspection. Now that's terrifying. When they do that, they give you a short period of time to send off the information, and then they come and see you, and actually they are getting much quicker at following up. We're seeing follow-ups within a month and a half of a visit, where it used to be about 6 or 7 months after they visited you, you'd actually hear from them. And what they're doing is, if they find non-compliance, they're asking the firm to agree a compliance plan with them to get back into compliance, and they're getting maybe 6 weeks to get into compliance. So what I'm saying to you is, if you get that email and you are not compliant at that point, you are very likely to be asked to either rectify that within 6 weeks or referred for disciplinary. So what one thing should you do now? Make sure that you are ready for the regulator to knock on the door. Now, I would never have said that to you a few years ago. I'd have said, now then, you know, it's really unusual if they come and knock on your door. It is not unusual anymore, folks. So if you haven't in the last 5-6 years had an inspection, and you've not been through that process since the 17 regulations came in, I would take steps. The other thing that they are asking for, and this isn't me pitching for work, they are asking firms to supply their independent audit report now to them. They didn't used to ask that. They've started asking. And they've previously said a number of times they expect most firms to have an independent audit. Now, an independent audit doesn't necessarily mean it's an external audit, but for it to qualify as an independent audit, the person conducting the audit or people conducting the audit must be independent from your existing compliance function. They mustn't have been involved in putting the program in. And the problem for most smaller law firms is that you probably don't have anyone who knows money laundering well enough that wasn't involved in putting it in the first place who could be conducting that audit. Whether you have to have an audit is subject to something called a size and nature test. You have to be of a certain size and nature. There isn't a tariff. There isn't a number of partners multiplied by offices or anything like that. You've got to make a decision yourself, and you should have been making this decision for a little while on your firm-wide risk assessment, recording it on there. I say should, not because the law says so, but that's an obvious place to demonstrate you've done it. And so you should have already made a decision whether you need one or not. What we are seeing is the regulator saying fairly regularly in their reports, one thing that firms that we are disciplining have in common is that they haven't had an audit, so that they haven't had it tested until the SRA get there. So I would make sure your regulator ready, and by checking that you are complying with the LSAG, and if you feel that you're a size and nature, make sure you've had an audit, and then you've done whatever the auditor's told you to do.
Fantastic. Thank you, Amy. Right, I'm aware of time, so we'll quickly just go through this. So if you just click on a few clicks for me. Yeah, one more. Thank you. I didn't realize it was animated, so apologies. Thank you everyone for joining today. So just to let you know, Amy's actually going to present another couple of webinars. The first one being on the 31st of July, which is about economic crime and the fact that it's not just AML anymore. So a bit of an extension. This is a series of 3 from Amy. And the next one will be then followed by the law firm of tomorrow, which is the 21st of August. Unfortunately, I won't be able to join you for that one because I'll be sunning myself in Turkey. So apologies, Amy, for that one.
I'll be in Australia, but I'm still turning up.
There you go. That's brilliant. Okay. But then in September, we'll be talking about value-based pricing as well, which is a new webinar that we have coming up. And then in October, we're doing a cybercrime. And there will be a few other webinars interspersed, but we'll email out to everyone to let you know about those. It only remains for me to say thank you very much to Amy for a very informative webinar. And thank you to everybody that's turned up. There were a few other questions which I kind of answered live. And yeah, we'll be in touch with the next for the next webinar. So thank you, Amy, and I'll bring it all to a close and end the webinar there. Thank you all. Have a good day. Bye.
Thank you. See you later.